Hello everyone, my name is Eugene and today I would like to share my crypto portfolio strategy for 2025. This project is based on the three key ideas. First is diversification to reduce crypto volatility. I have included traditional assets such as gold and fiat currency pairs to stabilize portfolio fluctuations. Second is utilizing DeFi instruments. To enhance profitability, I leverage staking and liquidity pools, which provide additional yield opportunities. And third one, a macroeconomic and fundamental approach. The portfolio was structured with the potential return of Donald Trump in mind. Given the current political landscape, I anticipate that 2025 will not be a year of significant crypto growth. Instead, I expect a moderate uptrend or a sideways market due to increasing regulatory pressure on the crypto industry. Now let's dive into the portfolio structure. You can find the detailed spreadsheet via the link in the description. Please note that the direct link to the spreadsheet is included in my article on an external platform. This is still a work in progress and my first presenting in this format. I appreciate any feedback and comments. So let's move to the crypto portfolio itself. In my spreadsheet, I created the main page in the form of the convenient menu where anyone can enter their own data and calculate returns based on their investments. As I mentioned earlier, the portfolio is completely open for use. So if you're interested in testing it or making any modifications, you can do so yourself or contact me if you want. So the first key idea behind this portfolio was to attempt reduce volatility and introduce hedging mechanism by incorporating traditional financial instruments. So the core of the portfolio, as you see, consists of leading cryptocurrencies. It's Bitcoin, Ethereum, Solana, Avalanche, and Toncoin. Although Toncoin is currently going through a rough period, it was show interesting behavior, particularly over the past 12 months, since its movements have almost no correlation with Bitcoin's volatility. Therefore, in this table, it's also included as a volatility hedging element of the main assets. So additionally, I have included gold as a traditional safe haven asset and Euro-USD currency pair, as I have observed an uncertain pattern and low correlation with the main assets Bitcoin. To assets performance, I use data started from 2018, and for assets launched later, I included data from their inception. To compare the portfolio with traditional market, I used the S&P 500 index as a benchmark and calculated key parameters relative to it, such as portfolio alpha, average volatility, and standard deviation. On average, including currency pair, the portfolio has returned 182% since 2018, whereas S&P 500 has yielded only 15.89% over the same period. I also analyzed the evaluationary matrix to evaluate the interaction between all assets. Within the calculation table and prevent two calculation methods based on this. It's right here. The first method involves standard equal weight allocation across all assets in the portfolio. Using this approach, I calculated the coefficient of variation, which I used to analyze risk relative to return. The result was one moment here, 2.28, while lower values are generally preferable. A coefficient of 1.28 is considered reasonable for portfolio assessment. In fact, I have seen traditional assets portfolio with significantly higher coefficient. I also attempt to rebalance the portfolio assets allocation to reduce the coefficient of variation. It's right here. However, using standard Excel or Google spreadsheet tools for optimization, Tough Excel offers greater flexibility in this area, but did not yield any meaningful improvements. Regardless of the rebalancing method used, the coefficient of variation remained higher than the standard equal weight allocation. Based on those findings, the first objective, reducing cryptocurrency volatility risk, by integrating more traditional assets, was successfully achieved with a coefficient of 1.28. This suggests what a standard evenly weighted assets distribution is the most optimal approach of this portfolio in this stage. The second objective we set was to increase the portfolio profitability by incorporating non-standard DeFi instruments, such as staking or farming. In this case, farming of token on the Solana network was aided. You can find the example on the farming setup on the main page via that link. The farming strategy was selected randomly using average yield figures, and it is not a core component of the portfolio. This means the portfolio can be effectively managed by replacing one farming strategy with another in the initial of experience as decline in returns. This approach provides great flexibility in portfolio management. The farming which we aided included in the calculation is projected to yield an annual return of 250% yearly. Adding into the portfolio helped reduce the standard deviation from 182.63% to 169.35% with farming, was significantly lowering volatility. Further analysis of the evaluation matrix, considering farming and the balanced assets allocation, showed what under the standard equal weight distribution, right here, the coefficient of variation was 1.29, which didn't improve the portfolio efficiency. Without farming, the coefficient of variation equal weight distribution, as you remember, was 1.28. However, the rebalancing of the portfolio by allocating, right here, allocating 10% to each assets, including hedging instruments, and 30% to farming, the coefficient of variation improved significantly to 0.72, which is an excellent result. So how to use this table and farming integration? On the main page, you can view the current portfolio metrics. Here you can adjust the farming yield and the base investment amount right here. The farming yield can be modified, allowing you to track performance and enter real-time figures. If farming returns exceed a value of 1, the indicator will be right here, that one. Indicator will be highlighted in orange and then in the red, signaling the needs to look for alternative farming opportunities. You can also experiment with different farming strategies, input their values, and analyze their expected returns and coefficient of variation to determine the valuability. If the coefficient exceeds 1, I consider it unacceptable, though. Of course, you can still explore and work with it if desired. So, thank you for your attention. I look forward to your feedback, especially experts' insights, as this is my first model and it remains a work in progress. Stay connected and subscribe to the channel. I'll soon provide more in-depth financial models, not only for crypto portfolios, but also want to provide models for emerging crypto projects. Those models will present data-driven insights rather than just theoretical discussions. All the best and see you in the next video.